these are the things that we're going to be covering in this chapter. We have a lot of calculations to go through, a lot of different like procedures that we're going to work with in this particular chapter. So first thing we have to do is, again, to define coverage under federal income tax withholding law. So we've got to, that employer-employee relationship, we've kind of already established that. I'm not going to really go through that again. It's essentially it's the same as it is for Social Security, Medicare tax purposes. What kinds of payments are defined as wages for federal income tax purposes? This can be different, and oftentimes is different, from what we define as wages for Social Security tax purposes. So if you remember, we've got our wage, to get our tax, we've got our wage base, which is the amount that is taxable, times our tax rate, equals our tax, how much tax we're going to pay. So for Social Security purposes, our wage base, the amount that's going to be subject to tax, can be and oftentimes is different from the amount, the wage base for federal income tax purposes. And that is the case on an annual basis, and it can also be the case on a per pay basis. Okay, so we're going to talk about some things, some items that are deducted from our total wages to arrive at our wage base for federal income tax purposes in this chapter. And those are pre-tax deductions, or as they call them here, pre-tax salary reductions, not just salaries though, really pre-tax wage deductions, amounts that are then subtracted from our pay to arrive at what our wage base is for federal income tax purposes. We're going to look and use this Form W-4 in the chapter. A lot of you are probably familiar with this. If you've ever started a job before, you've filled out a W-4 form. The W-4 form is filled out by the employee and used by the employer to help determine what that calculation for federal income tax withholding is going to be. Then we're going to start computing federal income tax using, we've got a couple of different methods for calculating. Sometimes we have a choice and we can use either one. Sometimes we don't have a choice and we have to use one particular. You can see a lot of these, they say from 2020 or later. That's because our tax law changed significantly in 2017, and starting in 2020, they changed the withholding in order to match with that. Well, the tax law was passed in 2017, it was implemented in 2018. It took them a couple of years to actually then adjust the W-4 form and how income taxes were withheld. But that's why you see this from 2020 or later. The method changed for how the W-4 was filled out and how the calculation was done for withholding purposes. There are a couple of different methods we're going to go through. The percentage method and the wage bracket method. Don't be too concerned about those terms yet. You'll become familiar with them as we go on. There are some other alternative methods that we're really not going to go through as far as calculating, but we'll just touch upon the fact that there are some other methods for, they're just not as common. So we really don't go through that, how those are calculated. We will talk about income tax withholding on supplementary wage payments though. That's probably the easiest part of the chapter, by the way. The W-2 form. So again, those of you who have been employees or are employees would be familiar with the W-2 form. That's the form that employees receive at the end of the year that summarizes all of their pay during the year, their income, as well as the amounts that have been withheld. Federal income taxes withheld, Social Security taxes, Medicare taxes, state income taxes, as well as some other type of information that is included in that. we'll talk about certain information returns. Information returns are those returns that are sent out to individuals who have received payments for use when preparing their own individual tax returns. Mostly we'll talk about what are called 1099 forms, and those are sent out to independent contractors. State and local income taxes as well. So I've got some information in the chapter, and I'll go through, I'll pull up some of the supplements that I've got listed in the, or attached in Canvas. We are going to look at how Iowa does withholding. Iowa, by the way, is in the midst of some big changes with regard to income taxes. I think I mentioned this early on. We're moving to a flat tax. So that whole system will be a lot easier. The whole calculation for withholding for Iowa purposes will be a lot easier. I think it starts in 2025. It was originally supposed to start in 2027, but I think they've accelerated it. But we'll look at Iowa and how that is done. And then the last part of this, so I mentioned the tax law change and how that W-4 changed starting in 2020. Well, we're going to take a look as well at the old method. So 2029 or earlier, because those W-4 forms are still lingering out there. They're being grandfathered out, but there are a few employees that probably are still using the 2029 or earlier. If they filled out a new W-4 form, they are supposed to use the new form, right? But if they haven't filled out a new form since then, they may still be working under the 2019 or earlier. So we're going to look at that. I would assume that at some point here, they're just going to say, you got to stop using that and use the new form, but that's like 5-6 years ago. So it's time to move on. You'll notice when we get to that part though, that a lot of the stuff that the calculations or the methods that we use are pretty similar to what we're currently using. There are just a couple of factors that are different. All right, I do want to go into, I want to show you what's in the module here. Okay, so these supplements here, and I will put up again like a practice quiz and an outline for this chapter as well. Hopefully those are helpful to you. When you are doing your homework problems, I don't know if you've encountered this yet. If you're, probably not quite as much yet, but you'll encounter it in this chapter. If you're using the online book, it can be really annoying to try and look up the information on the schedules that when you're going to be doing your calculations. And I guess I can kind of show you, we got a little time here, I can show you what I mean by this. I'm going to go to the chapter and then try and pull up. Too many clicks. Actually, this probably isn't what I want the homework. So let's look at one of the assignments in chapter 3, or chapter 4 is 3. So So you'll have these assignments, and then if you want to click here, you can access the tables in order to help with the calculations. But when you access the tables, this is what you get. This is really hard to look at. I mean, I suppose you can make it a bit bigger, but then when you enlarge it, it's this over here. It's dumb. So instead of doing that, what I've got in here, where are we? I mean, if you got the paper copy of the book, I think the tables are in there somewhere. But I've also got a link to these tables here, which makes it a lot easier to access. So this is the publication that contains all the tables. And when you're doing your homework, the main ones that you're going to be using start on page 9, page 12, or page 56. So these are wage bracket methods, percentage methods, some for automated payroll systems, some for manual payroll systems, but I'll just show you. So this is a lot easier to try and pull up. Okay, so these are some of the tables that we're going to be working with. This is a lot easier to look at. Of course, you could print it out if you wanted to do that. That is absolutely fine, but that's one of the items that is in there. Also, the Iowa withholding instructions are in there. Publication 15, which is called Circular E. This is an IRS form. This has, this might be a good thing for you to bookmark as well. This is essentially the class. I mean, this summarizes a lot of what we talk about in the class. So this is a publication that is intended, it is directed at employers for quick reference to different topics within payroll. So if you're not so sure about how you should treat supplemental wages, here's some additional information that's kind of worded a little bit differently than how the book is wording it. So this would be a good place as well if you're not understanding a concept. Maybe you go there and take a look at how it's explained here. Now it is by the IRS, so I mean, it's probably it's not like, I mean, it's readable, but it's the IRS. So some of it may be a little bit, I don't want to say higher level. They do give you some examples in here though for explaining the concept. So that's in there. And then the Iowa stuff. I don't know where I've got those separated out there. So that is up there for you. All right. Let me go back. Okay, so coverage under federal income tax withholding law. So again, we've got to have that employer-employee relationship. It's the same as what we talked about already in chapter 3, so we're not going to really reiterate that. You've got to have, essentially, if there is an employer-employee relationship, then the employer is required to withhold federal income taxes, just like they're required to withhold Social Security and Medicare taxes. If there is not an employee-employer relationship, then there does not exist that responsibility. We're talking independent contractors, partners and partnerships, that sort of thing. Okay, so it has to be an employee. Statutory non-employees are kind of this weird classification of employees. They are technically employees, but they don't have any federal income taxes withheld. Their income is reported on a W-2 form, but they get to offset their income with expenses. Most employees don't get to do that, right? If you're an employee and you happen to pay out of pocket for certain expenses, or you use your personal car on business, that sort of thing, unless you get reimbursed by your employer, you're not going to get any tax benefit from that. It's just money that you've spent. You're not going to get any deduction for it. Used to be you did get a deduction for it, but they took that away. That was with the 2017 tax law as well. But these statutory non-employees kind of fall into this gray area where their income is reported on W-2s, but they do get to deduct their expenses. And they're very specific classification. So individuals who are direct sellers and qualified real estate agents. I think there are some insurance agents in there as well. But that's just kind of an FYI that they exist. So there is a classification of gray area for employees. But our main concern is those people who we know are employees, and that employee-employer relationship does exist. So what types of wages are subject to federal income tax withholding, or what types of payments? So wages and salaries, just like with Social Security and Medicare. So if you are paid a regular wage or salary, whether you're paid on a salary basis or an hourly basis or a piecemeal basis, how you're paid and how that pay is calculated doesn't matter. What matters is that you have this employee-employer relationship. Vacation pay. So if you take a week off and you still get paid for it, that's still considered wages and income that is subject to federal income taxes. Any supplemental payments would be included in that. Bonuses and commissions, those again, just like with Social Security and Medicare. Tips, that also is considered to be taxable for federal income tax purposes. Cash awards, and then there are certain taxable fringe benefits that are included in wages. So what I'm talking about here are items where the employee doesn't get cash, but they get some other sort of benefit. But that benefit adds to their taxable wages. So now they're paying tax on wages that they actually didn't receive, but they received it in the form of a benefit. Okay. An example of that is gym membership. So if an employer pays for a gym membership, it's hard to talk. So if an employer pays for a gym membership on behalf of an employee, and that gym membership is off premises, so for example, let's just say an employer pays for a YMCA membership on behalf of their employee, $90 a month, whatever. That $90 a month, the employee is not getting $90 a month, right? But instead, they're getting a benefit that is worth $90 a month. But that $90 a month then is added to the taxable wages and is subject to federal income taxes as well as Social Security and Medicare taxes. So they're paying for, they have to pay taxes on benefits where they didn't receive the cash, but they received some sort of benefit where they didn't have to pay the cash. I mean, it's saving them from then out of pocket paying for that gym membership, right? So that's what we're talking about with regard to taxable fringe benefits. Let's see. Some items that are considered to be taxable payments to employees. So disabled workers' wages, any wages that are paid after the year in which the worker became entitled to disability insurance. So this here we're talking about like they're receiving disability payments, not short-term but long-term disability payments. So the year after they become entitled to that, if they are still receiving disability benefits, those would be subject to federal income tax withholding. These drawing account advances, what oftentimes happens for salespeople, I think I mentioned this in an earlier class, for salespeople, especially, I think I had mentioned like financial advisors in particular, if they are 100% commission based, they have to sell at least a certain amount in order to make their wage, but the employer is required to pay them their wage. So if they didn't sell enough to make up for that, then they have an advance off of future earnings. So those are drawing account advances. So those are still considered to be taxable payments for federal income tax purposes. Gift certificates that an employer gives to their employees, that's considered a cash equivalent to the employee, would be taxable. Meals and lodging, same factors apply. So if it's for the benefit of the employer, it is not taxable. If it's for the benefit of the employee, then it is taxable. Moving expenses, this is another thing that changed with the new tax law. So moving expenses, it used to be that employees, if your employer moved you to a different location and they paid the costs of the move, so maybe, the cost of renting the truck, the costs of hiring people to help pack up or sort of temporary storage, that sort of thing, that would not be included as taxable income. Now it is included as taxable income, and that can be a significant hit for a lot of people. I think I had a student in my income tax class when we were discussing this who mentioned that she was hit with this huge tax bill because the employer helped to pay for moving expenses. They didn't get the cash, they just didn't have to pay for the moving expenses, but the value of that was then added to the W-2, and they ended up having to pay tax on that. So the value of any of those moving expenses, with the exception of reimbursements to members of the U.S. Armed Forces, there are other specifics about them having to be deployed for active duty and that sort of thing. There is an exception for that. But for other folks, if your employer pays for your moving expenses, you are going to have to pay tax on the value of that. So if an employee spends half or more of a time in a pay period performing services subject to employment taxes, then all pay in that pay period is taxable. So here's where I'm talking about maybe the employer-employee relationship exists for certain duties, but then it doesn't exist for other duties. So you're providing services as an employee to your employer, but then you're also an independent contractor for your employer. It's sort of weird little, you have two hats on. If more than half or more of your time is as an employee, then all of your time is considered to be as an employee during that pay period. Payments to non-resident aliens are still subject to withholding. There may be actually some additional withholding that is required in those cases as well, but those are subject to income tax withholding. Scholarships. So if the student receives cash or reduced tuition in exchange for teaching, so they're actually performing a service, teaching, research, or other services, and it's a condition of receiving that scholarship, they're considered to be really an employee because they're providing services there. And that would be subject to withholding. Also sick pay, sick pay. So even if it's, sick pay, just like vacation pay, would also be considered taxable wages. So supplemental unemployment compensation, and this is, unemployment compensation is taxable. It's really, and it's subject to withholding at the source, so it would actually be the state that's withholding those amounts. Travel and business expenses. There is a distinction here between what we call accountable plans and non-accountable plans. So what I'm talking about here is if the employee is reimbursed for some of those expenses, like they go to have an employee that goes to a conference, go to a conference in, New Orleans, and the employee pays out of pocket to go to that conference and then gets reimbursed by the employer for the expenses of that conference. Now, if the employer has what's called an accountable plan, and it's just a form that, it's just a document. It's pretty easy to put together, and it's not a document that the employer has to send anywhere. It's just something they have to have on file, saying they have this accountable plan. Then the employee doesn't have to. That will not be added as taxable wages to their W-2, so they won't have to pay any tax on that. However, if they do not have an accountable plan in place, then that is considered to be taxable wages by for the employee. The cost of attending that conference, even though they were attending it for employment, right? Also, if the employee receives a travel advance, but they're not required to return any overpayment. So that conference in New Orleans cost $2,000. The employer gave me $3,000 in order to attend it, and they didn't ask me for the extra $1,000 back. That extra $1,000 will be considered wages and subject to income tax withholding. Okay. Questions so far? Let me go through that in a minute and see if there's. Okay, fringe benefits. These are items that are added, and there are two different types of fringe benefits. There are taxable fringe benefits and there are non-taxable fringe benefits. So fringe benefits are items that are benefits that are provided by the employer. So the employer is paying for them. And the employee is receiving then some sort of non-cash benefit. So it's not going to be in the form of cash. Like I said, we got certain ones that are taxable, certain ones that are non-taxable. That's important because if we think about it, for our wage base, if they're taxable, then we're going to have to add any taxable fringe benefits. Right? So that's going to increase our wage base. How much is going to be subject to our tax rate? Those taxable fringe benefits. Non-taxable fringe benefits, we're not going to add that to our wage base before we do the calculation. So to determine the value of that fringe benefit, we take what the fair market value of the benefits are minus any amount that maybe the employee is paying. Okay. Some items that are considered to be non-taxable, so these would be items that we do not add to our wage base. Services that are provided at no additional cost. I think the book gives an example of, or maybe it's the income tax book. Sometimes I mix those two up. So we're talking, an example of that would be if you work for an airline and they have an empty seat, and you can, as an employee, you can take that seat. It's not going to cost the airline any more. Maybe a little bit more in fuel, but can't really calculate what that is. But it's not costing the airline anymore for you to go ahead and take that seat. That would be a service that the employer is providing and it's no additional cost to them. That would be a non-taxable fringe benefit. Qualified employee discounts. So discounts up to, I think it's 20%, are considered to be non-taxable fringe benefits. Use of on-premises athletic facilities. I used the example of a gym membership earlier. If the gym membership is for a gym that is on the premises of the employer, so for example, DMAC here has a gym, and employees can be members of it if they so choose. That's an on-premises athletic facility. There's no cost to the employee to do that. It's not going to be added to their wage base. If it's off premises though, so DMAC also offers, if you have a membership to another gym that's off site, they will help with a part of that reimbursement, but the part that they help with is taxable to the employee. So if they reimburse you, I don't even know what the amount is, it's not much, like $10 a month. They reimburse you $10 a month, $120 a year. That $120 then gets added to the taxable wages for withholding purposes and also for income tax purposes. Reduced tuition for education. So if the employer provides a tuition deduction for its employees, then the value of that is considered to be non-taxable. other working condition fringe, I don't know if they've got, there is, and so they mention here the list in the Circular E, which is one of those documents that I provided for you. So that's the T. This is the Circular E. Let's see what the Circular E has to say about wages. They talk more here about accountable plans versus non-accountable plans, so if you want more information about that. Where are fringe benefits? Non-taxable fringe benefits. Let's see. Transportation fringe benefits. Minimal values, so occasional cab ride when an employee must work overtime, meals that you provide at eating places that you run for your employees if the meals aren't furnished at below cost, athletic facilities, tuition reduction, that sort of thing. So I guess it doesn't really say additional. Did it say something about the working condition? Employer provided cell phones provided primarily for a non-compensatory business reason. So if you've got to be on call and they provide you a cell phone, that sort of thing. So these are items that are specifically excluded. So we would not add any amount to that wage base in this case. However, there's for the items that are included that we would have to add a value, a fair market value to the wage base. There are a couple of different ways that we can do it. One is that we can value the fringe benefits separately and then withhold at a 22%, flat 22% tax rate. You'll find that that's also the bonus rate, by the way, the 22%. Or, and that more commonly what happens is that the value of the fringe benefits are added to regular wages. You treat it as one paycheck and you withhold on the total. So for example, if we've got a paycheck, if we got $1,000, this is our pay of wages. And then we have $200 of taxable fringe benefits. Now our taxable pay, or our wage base, is the full $1,200, and then we'll just use our normal methods of withholding, which we will go through in this chapter. Okay, so they have an example here, flexible reporting option. You can also, well, they have an example of a flexible reporting option. So you can treat the benefits as being paid on one or more dates in the same calendar year. So I've got an example here, a country club membership of $200, which would be taxable. So if you get, your employer pays for your country club membership, they're gonna add the value of that country club membership to your wages. And you will pay tax on that $2,000 value. They can do it in one lump sum, or they can spread it out over the course of the year, right? Add it to maybe each paycheck. It will be a lot easier on the employee if it's added to each paycheck and spread out over the year, right? Okay, so let's see. Questions so far? One thing I wanted to, so I'm gonna stop with the slides right now, but one thing I wanted to show you in here, where is it? Is, so this table here. So employer, there are two different, there's another classification of benefits that we're gonna talk about which are paid by the employee. What I talked about here is our fringe benefits that are paid by the employer, and whether or not the value of those benefits is going to be added to the wages for tax calculation or not. So employer provided benefits fall into these two categories. of taxable, otherwise non-exempt, not exempt from taxation, where the fair market value is added to taxable wages before we calculate the withholding. And then we have the non-taxable ones, and the fair market value is not added to our taxable wages. So it's just sort of free money, right? So those ones that we just went through that are non-taxable, that's just sort of free stuff. We have another category, which we are going to go into a little bit more as well. These are employee paid benefits. Things like health insurance, like if your employer provides you with health insurance and you have to pay all or part of it and it's withheld from your paycheck. There are two different categories of those. We have post-tax and pre-tax types of employee paid fringe benefits. If they're post-tax, that means that we subtract the amount of the benefit that the employee is paying, we subtract the deduction after we calculate withholding. So we do all the calculations, how much is our withholding, and then after that, we're going to subtract what has to be paid and withheld by the employee. Then we also have a classification of pre-tax. These are amounts, again, that are paid by the employee, subtracted from the employee pay before we calculate our income tax. These lower our taxes. As employees, these lower our taxes. Also, these, they don't directly lower our taxes, but it means we don't have to pay out of pocket for something that we're receiving, right? So we're going to go through those calculations more within the chapter, but I wanted to point that out. That table is listed in the agenda, where is it? What do I call it? Chapter 4 in-class activities in the agenda there. Okay, so I'm going to end that, well, out of time anyway. We're going to end that there. We'll pick up, we'll talk about tips. Yay, everybody's favorite topic. We'll talk about tips and some other aspects when we come back on Tuesday, and we'll get into some more details. Okay. Questions?